Welcome to this Explainer. We're going to do something a little bit different today. We are going to step directly into the shoes of a professional sell-side equity analyst. Our mission? To conduct a rigorous, fully documented intrinsic valuation of Belden, ticker symbol BDC. Now, as strict fundamental analysts, our golden rule for this session is simple. We base our analysis entirely on the source filings. No guessing, no getting distracted by market noise. We're just going to let the math and the documented metrics tell the actual story here. All right, let's get into it. Here is our analyst roadmap for today. We'll start with the valuation assignment, move into absolute valuation, looking at DCF and DDM models, discuss handling missing model data, then touch on relative valuation and multiples, before finally synthesizing our intrinsic value.
Okay, part 1, the analyst valuation assignment. Before we even think about building a model, we need to know exactly what the market is asking us to evaluate.
Belden currently trades at a last close price of $112.01. So that's our target. Our specific assignment is to tear down the financials and figure out if this price tag is actually fundamentally justified by the data, or, if the market has maybe gotten a little ahead of itself. We're looking at a market cap sitting right around $4.3 billion. The big question is that valuation grounded in reality? Let's find out. Moving right along to Section 2, Absolute Valuation, covering DCF and DDM. This is where we get to look at the raw cash the business generates. So a proper textbook discounted cash flow, or DCF, model requires a few foundational steps. You derive your unlevered free cash flows, figure out your cost of capital, build out a forecast with a terminal value, and then discount it all back to present value. But here's where we really have to act like professionals. Our source data today gives us the final calculated outputs rather than the granular line-by-line inputs for a multi-year forecast. So instead of making wild, ungrounded external assumptions about things like terminal growth rates or the weighted average cost of capital, we're going to observe the resulting fair value directly from our data set. And comparing these two numbers gives us our first major, kind of sobering anchor. Belden generated a trailing 12-month free cash flow of roughly $218.69 million. Now that is real cash. But the mathematically derived fair value price based on those cash flows sits at just $84.26. Remember our target trading price of $112.01? Yeah, we're already seeing a pretty significant disconnect between the current price and the intrinsic cash flow value. Naturally, any thorough analyst would then try to run a dividend discount model, a DDM, to see if maybe that justifies the price. But attempting a DDM here proves mathematically ineffective. Why? Just look at the constraints we're working with. We have a microscopic dividend yield of 0.18%. The compound annual growth rate over the last 3 years and the last 5 years is exactly 0%. Plus, there have been 0 consecutive yearly increases. BDC simply lacks the consistent dividend payout and growth needed to make a DDM a reliable indicator of value. So we literally have to scrap it. All right, Section 3, handling missing model data. Because in the real world, you don't always have perfect information, and we have to handle the limitations of top-level reporting. As rigorous analysts, we've got to explicitly declare our boundaries. We're provided with some fantastic top-level metrics, like a debt-to-equity ratio of 1.02 and a really solid return on invested capital of 11.43%. But without distinct segment financial reports or granular balance sheet line items in our provided filings, we have to exclude the sum of the parts, adjusted present value, and asset-based liquidation models. To even attempt them would require reckless, undocumented external assumptions about individual asset values and segment overhead. So we document the exclusion, and we move forward with what is mathematically verifiable. Let's jump to Section 4, Relative Valuation in Multiples. Since our absolute valuation showed that disconnect earlier, let's see how the market is currently pricing Belden's earnings power compared to its peers. Okay, let's talk multiples. Belden boasts a trailing price-to-earnings ratio of 18.95, a forward PE of 15.70, an enterprise value-to-EBITDA ratio of 11.70, and a price-to-book ratio of 3.45. Now, because our specific source documents do not explicitly identify comparable companies, we are forced to declare an external assumption here. A professional analyst would select a standard industry peer group, likely other electronic component or networking equipment manufacturers, to contextualize these trailing metrics. On their own, a PE of almost 19 implies the market expects some pretty healthy sustained growth. And to be fair, that market optimism isn't just coming out of thin air. We have to constantly juxtapose our intrinsic valuation concerns against the company's historical performance. Belden has delivered a massive 135.18% return to shareholders over the last 5 years. They're posting a very healthy return on equity of 18.78% and pulling in over $2.7 billion in trailing revenue. The operations are solid. But as analysts, we know the golden rule. A great company does not automatically equal a great stock price if you end up overpaying for it. Which brings us to our final section, synthesizing intrinsic value. This is the crucial point where we pull all of these separate data points together into a final conclusion. And here is where the data ultimately leaves us. When we compare that discounted cash flow fair value of $84.26 against the current trading price of $112.01, we are faced with a deeply negative margin of safety of minus 32.94%. In fundamental analysis, your margin of safety is your buffer. It's your protection against errors in calculation or unforeseen economic downturns. You really want it to be positive. A negative 33% margin, that means you were paying a heavy premium for future growth that may already be fully priced into the stock. Which leaves us with one final, absolutely critical thought to analyze. With BDC trading at a roughly 30% premium above its mathematically derived fair value of $84.26, is the market simply being irrational? Or, giving its incredible 5-year run of 135% returns and strong return on equity, is Belden currently priced for absolute operational perfection? As analysts, the math tells us the downside risk is elevated. It's up to the market to decide if the future growth can outrun this current premium.